All right, what the heck happened to Domino's Pizza stock today? For more than 5 years, this has been one of the best performing stocks around. As CEO Patrick Doyle has led the company through a remarkable turnaround, transformed it to one of the strongest growth stories in the restaurant space. In fact, just last week, Domino's, which has 11,700 locations across the globe, pre-announced some spectacular same-store sales numbers. But when the company reported this morning, Domino's missed Wall Street's top and bottom line estimates, which sent the stock plunging down $5.39 or 5%, in part because the company does so much business overseas that the strong dollar has been a real problem for the numbers. And even though the same-store sales were excellent, there was one line item in this quarter that caught me by surprise. Company's supply chain revenues, meaning the money it makes from supplying its 11,000-plus franchises, came in lighter than I expected. Which brings us to the big question. Did Domino's hit a one-time speed bump, giving you a terrific chance to buy the stock in a weakness, which we haven't had very often, especially when there might be some newfound flexibility for a special payout to shareholders because of some bond action? Or do we need to get more cautious? Let's check in with Patrick Doyle, the fabulous president and CEO of Domino's Pizza, find out more about the quarter and company's prospects. Mr. Doyle, welcome back to Mad Money.
Thanks, Jim. Appreciate it.
All right, Patrick, typically I would talk about technology, and we're going to get there. I would talk about the new emoji pizza ordering and how much is ordered on digital. We're going to get there first, but I need to ask you, there was some confusion involving this, some headwinds. Foreign exchange, I think people understand that. People don't seem to understand the interaction between food prices and how that affects your bottom line. Maybe if you walk us through that, people understand that this is not such a disaster of a quarter.
Right. Yeah, no, I appreciate it. So it's really pretty straightforward. When food prices are low, it's great for our franchisees. When they're higher, it's a little bit tougher. We price on a cost-plus basis. So the plus is our margin. That remains constant. When commodities are down, that actually means our revenues, our selling to the stores, will actually look lower, but we make the same amount of money as a company, whether the commodity price is high or whether the commodity price is low. So they're low right now. We're actually saying down 5 to 7% for the year versus last year. That's a good thing for us overall. The profits in supply chain were good. It just makes the revenue line look a little bit kind of, lower than it would be otherwise.
Also, I think people have to understand the magnitude of the foreign exchange. What would have been your numbers, say, 2011 versus 2015?
Yeah, I mean, we're actually missing over $1 billion in retail sales, so kind of in the range of 30 million plus in royalties if we were at the same exchange rate we were at 4 years ago. So, we're looking to, as much as $20 million hit to the bottom line for the year this year because of the FX headwinds. We've got to perform through that. We have. Our growth is terrific. We're excited about where the business is overall, but certainly the FX headwinds have been strong.
Finally, there was an insurance item that came in that was also hard for people to understand. The insurance, Forex, and the supply chain made people feel like, well, a second, maybe we got a Pizza Hut on our hands here because that was yesterday's disaster.
Yeah, no, and you covered that well yesterday. They've clearly got some things they've got to work through. But no, I mean, at the end of the day, what matters for the health of the business are we getting the top line growth, double-digit up, same-store sales growth domestically, fourth quarter in a row, up well over 7%, almost 8% on our international business. We feel very good about where we were. There clearly a little bit more story this quarter than usual, but we feel very good about where we are.
All right, talk to me about emojis and loyalty.
Yeah. So emojis, we just continue to find new ways for people to access the brand. It keeps us very top of mind around technology. We want to make it easier for people to order from us than anybody else, and we continue to do that. And loyalty is a great add-on. We've been working on this, researching this for a while. We like what we see. We just rolled it out nationally, and we feel good. When people get it right, and what it means is simple. If you can make it simple, it drives things for customers. So we'll see. It's all fourth quarter. But we wouldn't have rolled it out in the fourth quarter unless we felt like it was going to do good things for us.
All right, I saw some numbers that were disappointing in Yum, not just China. They had a big decline in India. India's been very important to me, as you know, because I know that a vegetarian country, to some degree, should be good results for you. Are you seeing a slowdown in India like they saw at Pizza Hut?
No, we're not. I mean, our master franchisee had already released the first half of the year. They were up mid-single digit. It's certainly been a little harder. The economy has been a little slower in India. We're still growing. Our store growth in India continues to be terrific. We're opening in the range of 3 stores a week in India. So overall, we're in good shape there.
When you talk about the food price coming down, just to circle back to that, if you're a franchisee, you want to open more stores if you get that kind of leverage, right?
Absolutely.
And that's part of your growth. Part of your growth is not just technology, but is to have more stores.
That's exactly right. And the best thing in our numbers is our franchisees are making more money than ever. Last year, they made $89,000 average per store. It costs about $300,000 to build a Domino's store. This year, we're saying we should be at or above $100,000 per store. That would be all-time record for our franchisees. So they're building more stores because they're excited about the investment in Domino's.
All right. Well, Patrick, it was obviously a noisier quarter than we're used to. Some headwinds. You're a straightforward guy. I totally get it now. Patrick Doyle, President and CEO of Domino's Pizza. Good to see you, sir.
Thanks, Jim. Appreciate it.
We haven't seen this stock have this kind of discount before, other than one other time when it was in the 30s, going down to the 20s, and then you caught a 5-bagger. I like Domino's here. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.